For the last 15 years, our entire global economy has been running on a kind of experimental fuel. It was an unprecedented policy, one designed to save us from one crisis that, well, it may have just set the stage for the next one. So let's get into it. This is the epic story of easy money. And where do we even begin? Well, let's start with what's happening right now. This is a pretty stark warning from the head of the U.S. Federal Reserve, Jerome Powell. He's basically telling all of us, look, the medicine we need to take to fix the economy, it's going to hurt a lot. So that just begs the question, right? How on earth did we get here? How did we get to a point where the only solution on the table is pain? And what exactly is this age of easy money that everyone's talking about? Well, to find the answer, we have to rewind the clock. Okay, so our story really kicks off back in 2008. The entire global financial system was, and I mean this literally, in an absolute freefall. It was a terrifying moment, and it called for something radical, something that had never really been tried before. And it's really hard to overstate just how bad things were. I mean, one former Fed official put it this way. Imagine the economy's veins, its capillaries, its arteries, they had all collapsed. Everything just stopped working. The system needed life support, and it needed it fast. And that life support, it had a name, Quantitative Easing, or QE for short. Now, this is the part you really got to wrap your head around because it's the key to this whole story. QE is basically the central bank creating money out of thin air, digitally. But here's the twist. They don't give it to you or me. They use it to buy bonds from big banks. The whole theory was, let's flood the banks with cash, and that will get them to start lending again, get the whole economic engine fired up. And on paper, the plan was, well, kind of beautiful in its simplicity, right? Step one, the Fed just creates digital money. Poof. Step two, they use that brand new cash to buy assets from the banks. Step three, the banks are now just swimming in cash, so they're supposed to lend it out to everyday businesses and people. And boom, step four, the economy gets the boost it desperately needs. Simple, right? A perfect fix. At least that was the theory. But here's the thing. What was supposed to be a short-term emergency fix? Well, it didn't stay temporary. It slowly became the new normal for over a decade. And that's where things start to get really complicated. This is where all the side effects, the stuff nobody really planned for, started to pile up. So let's look at the goal versus the reality, because this is where the plan really went off the rails. The goal was for banks to lend all that new cash out to Main Street. The reality? Well, the banks found it was way easier and more profitable to just invest the money or buy super safe assets. The goal was for companies to borrow the super cheap money and build new factories, hire more workers. The reality? They mostly used it to just buy back their own stock, which pumps up the share price. So the result wasn't this big, broad recovery for everyone. Nope. It was a recovery that mostly just supercharged the wealth of people who already owned assets. And I mean, just get a load of this number. Over $6 trillion. That's how much corporations spent just buying back their own shares during this easy money era. If you ever wanted a smoking gun for where all that cheap money was really going, well, there it is. A former Fed official, a guy who actually ran the QE program, he just nailed it with this analogy. He said it was like the old fable of the scorpion and the frog. The Fed wanted Wall Street to be the helpful frog to carry the economy safely across the river. But Wall Street, well, it's a scorpion. And a scorpion's nature is just to do what's best for the scorpion, which means making as much money as possible, as fast as possible. It can't help it. So what did all this do? It created this environment where the stock market felt like a one-way bet, like you couldn't possibly lose. The Fed was basically putting a giant safety net under the entire market. So for investors, the game became incredibly simple. The number one rule was, don't fight the Fed. As long as they're printing money, you just keep buying. So for about a decade, this is how things worked. The whole system just chugged along, totally hooked on this constant flow of easy money. And then 2020 happened. A global pandemic hits, and this time, policymakers didn't just turn on the fire hose. Oh no, they unleashed an absolute tidal wave. I mean, the response was just unprecedented. Nothing like it in history. The entire global economy was grinding to a halt, so the Fed and the US government threw everything they had at the problem. The sheer amount of cash they pumped into the system in just a few months made everything they did after 2008 look like pocket change.
And this quote, bazooka, cannons, and kanks all at once, it just perfectly captures the scale. See, this wasn't just the old QE playbook. This time they were sending checks directly to people's bank accounts. They were giving out massive loans to businesses. The Fed was even buying up risky corporate junk bonds for the first time ever. It was total, overwhelming force.
And the results? It was immediate, and it was absolutely wild. The stock market crashed for about a second, and then it just went on a rocket ship ride to the moon. You had the whole meme stock explosion, the crypto frenzy, everything went nuts. It really felt like a giant casino where you literally couldn't lose, because you knew the house, the Fed, was always going to have your back. But here's the thing. You can't just pump that much money into an economy when all the supply chains are broken and not expect consequences. And that big, ugly consequence had a name: inflation. And just like that, the party was over. The Fed was forced to slam on the brakes and make a really painful U-turn. And when I say inflation, I don't mean it just ticked up a little bit. It exploded. It blew right past the Fed's 2% target. And for months, you heard them say, oh, it's just transitory, it's temporary. Well, guess what? It wasn't a blip. It was a full-blown crisis. And it forced them to slam on the economic brakes harder than they had in 40 years. And look, it's easy to get lost in the charts and the numbers, but this is what it actually means for real people. This quote from someone at a food bank: choosing between your rent and your food, that just cuts through all the jargon, doesn't it? For millions of people, inflation wasn't some number on a screen. It was an impossible, agonizing choice. And the tragic irony is that the very people these policies were supposed to help were the ones getting crushed the most. And that, right there, brings us full circle, back to today. The Fed is now jacking up interest rates at a crazy pace to kill the very inflation it helped unleash. And what's happening? Well, a financial system that was built on a foundation of cheap, easy money for over a decade is now starting to look really, really shaky. I mean, if you look at this whole 15-year timeline, it really tells a story of escalating addiction. It starts in 2008 with that first emergency hit of QE. Then by 2013, you have the taper tantrum, which was basically the market throwing a fit when the Fed just talked about giving it a little less, showing how hooked it already was. Fast forward to 2020, and it's a massive overdose of stimulus. And now we're in the painful withdrawal. The rate hikes are revealing all the cracks in the system, and that's why we're seeing things like the collapse of Silicon Valley Bank. It's a direct consequence of the easy money party coming to a screeching halt. You know, Warren Buffett has a famous saying that just perfectly describes where we are right now. You don't find out who's been swimming naked until the tide goes out. Think about it. For 15 years, the tide of easy money was incredibly high. It lifted up everybody, even the shaky companies that probably shouldn't have been afloat. But now, that tide is going out, and we're finally starting to see who was actually built on a solid foundation and who was, well, you know. Which leaves us with this huge trillion-dollar question that we all have to ask ourselves. Was all of this a necessary evil, a radical cure that actually saved the world from a second Great Depression? Or did the cure end up creating a whole new disease, a fragile financial system that's now dangerously, maybe even fatally, addicted to a drug it can no longer have? The bill for the age of easy money is finally here. It's come due. And we are all about to find out just how high the price really is.